Global equities have remained in a relatively tight range over the last month or so and are down approximately 1% in local currency terms or 3% in euro terms year to date. While early year concerns over a significant slowdown in growth or possible recession have eased considerably, recent global economic data has been a little mixed. Following a notable improvement from February on the back of fiscal and monetary stimulus measures, recent Chinese data has rolled over somewhat, but remains much firmer than expected at the beginning of the year. European data has generally remained strong, with Q1 growth across the Eurozone running at a 2% annualised rate. US data has been more mixed than elsewhere, with some softer data points in April, notably in the labour market, although retail sales and industrial production releases in May have been much stronger than expected and are consistent with growth in the current quarter of about 2.5% annualised. On the back of the reduced global risks and continuation of moderate growth in the US economy, the US Fed has reopened the possibility of raising interest rates in the middle of the summer without any negative follow-through into equity markets. In the UK, however, macro releases, both sentiment surveys and hard data have been weaker in recent months, impacted by the uncertainty associated with the upcoming Brexit referendum. The referendum on June 23rd is seen as the biggest risk for markets in the short term. On June 23rd, the UK is holding a referendum to determine if the UK will remain a member of the EU, and is probably the biggest short-term risk facing markets in coming weeks. The cost to the UK of a vote to leave the EU are seen as high. The majority of independent studies estimate the economic hit to UK growth in the event of a vote to leave as being 5 to 10% of GDP over a period of 10 to 15 years. The negative hit to growth would be expected to rise from the uncertainty caused regarding the UK's relationship with trading partners following a decision to leave the EU. The UK would be required to renegotiate trade agreements with each single trading partner, and it could take between 5 and 10 years to do so. In the meantime, domestic investment and consumption decisions would probably be delayed given the uncertainty over trade barriers, while foreign direct investment into the UK would be expected to fall significantly for similar reasons. Increased risks of a breakup of the UK, with Scotland expected to renew demands for separation in the event of a vote to leave, and probable rating downgrades of the UK by credit rating agencies would also add to the sense of uncertainty. Risks of contagion to the wider European economy are limited from an economic perspective, with every 1% decline in UK GDP expected to negatively impact European growth by only -0.2%. Ireland is slightly more sensitive to UK growth, with a negative flow-through of -0.3%, due to the fact that the UK accounts for 15% of Irish exports, although this is down from the mid-40s level in the 1970s. The bigger risk, however, to Europe from a vote by the UK to leave would probably come from the questions it would raise about the long-term future and survivability of both the EU and the Eurozone. As seen in this chart, the Remain and Leave camps in the polls have been running very close, suggesting a very tight result in the referendum. However, as the apparent costs related to a possible exit have become more wide known, more recent polls have indicated the Remain camp has started to move ahead in the polls, with 2 polls last week suggesting a lead of about 15 points. Odds at bookmakers called both the UK general election and Scottish referendum correctly, in contrast to the polls at the time, are currently indicating an 80-20 probability for a vote to remain in the EU. Our base case is that the UK will vote to remain in the EU, and the recent softness in UK economic data will reverse through the second half of the year, with no negative follow-through in either an economic or political sense to the rest of Europe. Markets, however, will remain sensitive to news flow regarding the Brexit referendum and the actual outcome over coming weeks. We believe there is still some modest upside in equity markets, although it is likely to be more limited than the gains seen since the lows in mid-February. a possible marginal improvement in global economic data in coming months, prospects for additional stimulus from the Bank of Japan and possibly the ECB later in the year, some relief in the event of a UK vote to remain in the EU, and growing comfort with corporate earnings forecasts for 2016 provide support for equity markets. Equity markets are also supported by an environment of low yields in sovereign bonds and cash deposits. Although with absolute equity valuations around historic average levels, upside is limited to some extent.